Are Trump's tariffs killing American exceptionalism? An eventful end to FY25 for Indian markets, and why I'm buying the recent correction in Salesforce. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. The week gone by was one which further confirmed that the US consumer is getting gloomier and gloomier by each passing day. And it seems that he or she is devoid of confidence as well when it comes to the US economy or when it comes to the expectations of economic growth. To make matters worse, from a sentiment perspective, you got a glimpse of what Liberation Day, which is actually taking place tomorrow, given the fact this is, recorded on Tuesday, April 2nd, where President Trump is expected to announce a host of tariff measures, 25% on oil imports from Venezuela, or any transactions with Venezuela. You've got the reciprocal tariffs and so on. So the so-called Liberation Day, as President Trump puts it himself, we got a glimpse of it from a sentiment perspective of how this Liberation Day would look like. And we also got, to make matters much, much worse, we also got a much more hotter than expected inflation measure, one that is very important for the Fed. Yet another anything but positive week in short, clearly reflected in the US markets. Once the dust had settled, all three indices were back in the red. Remember last week they ended in the green. It was only that euphoria lived only 1 week. We're back in the red again. Dow tumbled 1%, S&P 500 fell 1.5%, and the tech-heavy Nasdaq declined 2.6%. Given the fact that it is April 1st, yesterday marked the end of the first quarter, and by the end of the first quarter, U.S. markets, it was the worst quarter for all three indices, for the entire US stock markets since 2022. Last week, I told you about how Fed Chair Powell is bringing back memories of 2022 when we had an absolute, inflation was skyrocketing, markets were down. Looks like the US markets are also following the same trajectory. Now, whether they will repeat the same trajectory, they will follow the exact same trajectory in the second quarter and the second half of the year remains to be seen. When March 31st ended, the markets closed on March 31st. It was the worst quarter since 2022. Not an ideal start to 2025. So, without further ado, let me quickly welcome you to the Doctor's Weekly Snapshot, the first segment, as always, and take you through all the major developments in US markets last week. As you can see from my voice, as you can feel the sentiment already from my voice, it's not exactly, I don't have much positive things to share. Still, we look at whether we can find some pockets of positivity, but I leave that to you once you've finished hearing to the full segment. Now, I'd already given you some indications about a month ago, about 3 episodes back, about the increasing pessimism amongst US consumers. Well, the latest economic data that we got last week suggests that it's not just pessimism that has crept in, but at the same time, the overall consumer confidence about the future US economy has fallen off a cliff. So not just negativity, but it's completely like it's the consumer is completely devoid. So it's a pretty gloomy outlook if you think about it. Negative outlook, completely devoid of confidence. It's just not the right. There's nothing positive to think about as far as the U.S. consumer is concerned. First, we had the Conference Board's Consumer Confidence Index, which fell to 92.9 in March, marking the 4th consecutive month of decline, while its forward-looking expectations component dropped to a 12-year low at 65.2. Then on Friday, when the markets absolutely, ended in the red again. It started off strong on Friday, then we got a couple of economic data, and then that fell off a cliff. On Friday, we got the University of Michigan's Consumer Sentiment Index, which actually plummeted to 57, its lowest level since, no surprises, 2022, further confirming a particularly gloomy outlook for the future. Now, this 2022 is becoming a hell of a pattern, I'll tell you that much. There's a lot of commonalities between 2022 and what we're having, but you have to understand, 2022 was a one-off horrible year. 2021 was great, 23 was great, 24 was great. So obviously, the earliest you can think of is 2022. We still had pain in 2018 and 19 when the trade wars were going on as well, but 2022 is like, most recent memory, right? So there's a lot of comparisons being made to the 1 year that the markets actually did not perform well at all. Now, the primary driver of all this pessimism, the loss of confidence, the low sentiment, negative sentiment values, all of that are the usual suspects. Impact from tariffs, government layoffs courtesy of Doge, and immigration crackdowns. Now, I'm not going to go into too much detail since I think I've talked about the impact that these things have been having on consumer, on economy, on the economy, on various economic indicators and so on at length. I've talked about in previous episodes. So I'm not going to keep repeating the same thing. You've already, the show already, and if you're still awake, you will definitely be asleep if I keep repeating the same thing. So I'm not going to do that. But what you do need to take from the sentiment data is that this cocktail of factors, that is the tariff impact, government layoffs, immigration crackdown, all of that have led to a widespread perception that the economy is heading for a downturn, if not an outright recession. This is despite hard data such as unemployment rates and GDP figures not yet showing any significant signs of this impending doom or impending recession that people are expecting. Now, you have to understand that this data talks about sentiment. Whatever I told you, the Michigan data, the University of Michigan survey, the Conference Board survey, all of that talks about sentiment, which may or may not translate into economic action. There have been periods where sentiment was downright negative, and yet spending continued to be strong. The reason why US markets are reacting so much negatively to this data related to perception is because of the threat that the feeling of uncertainty amongst the US consumer could lead to them delaying major purchases or cutting back on discretionary spending. And this is already happening in select companies. I mean, if you look at the guidance offered by major retailers such as Walmart and very recently Lulu, which reported its earnings last week, its stock plummeted 15%. I'm a holder in Lulu, so I know the pain. I've been through the earnings calls. I'm writing an equity report shortly on the company. 15% drop in the post the earnings release, another 5% drop, about I think about 3.5-4% drop yesterday. It's been up or fallen off a cliff because the guidance offered by these companies suggests the same, right? I mean, this suggests that consumers are cutting back on discretionary spending. They are cutting back on major purchases. So it is happening to an extent, and that's what the markets are really worried about, that this perception of negativity could translate into consumers cutting down on their spending. Now, the issue is that while a handful of retailers are issuing the warning, it could very well be the case that a ripple effect might occur through the economy, subsequently leading to a further slowdown, a significant slowdown in growth, even if it's not an outright recession. It is this possibility rather than reality. So the reality is that that the economy is doing well. It's on a decent footing. It is strong. There's no such data that there is no such hard economic data that suggests that we are going through a terrible period or any of that sort. But it is a possibility that we could be, because of the ripple effect from sentiment to actual reality, that that has made the markets negative. In other words, US economy is navigating a period of heightened uncertainty and declining consumer confidence, influenced by the cocktail of factors such as trade tensions, policy unpredictability, and so on. Now, while sentiment does not always dictate economic outcomes, it does serve as an important indicator of potential future trends. As consumers and businesses continue to express pessimism, economists are closely monitoring these shifts for signs of a broader economic slowdown. And this perceived negativity and uncertainty is what drove the sell-off last week, what caused investors to turn negative. Adding to this perceived negativity and uncertainty last week was also an inflation metric. Actual data in this case, no perception, nothing. Actual inflation data, which came in much hotter than expected. Unfortunately, the metric that came in hotter than expected is the one that is preferred by the Fed when it makes its rate cut or rate hike decision. When it makes its decision with respect to interest rates, this is the metric. The hotter than expected metric is what mattered. So you can clearly understand why the sell-off accelerated towards towards the close once this inflation metric was released. More specifically, the metric I'm talking about is the personal consumption expenditure, the PCE inflation metric. The core PCE price index, which excludes volatile food and energy prices, so it's more important to the Fed. This metric is more important to the Fed, rose by 0.4% in Feb. It's pushed the annual inflation rate to 2.8%, exceeding the expected 2.7%. Keep in mind that about 2-3 weeks ago, the CPI report had come in, and it had come in much better than expected, and markets rejoiced. Then the Fed came out and said that there is absolutely nothing to worry. Markets liked it too. Unfortunately, last week, everything that the Fed values, especially when it comes to rate cutting, decisions with regards to interest rates, came on the wrong side, and markets hated it. It is elementary, my dear, what is happening in the markets. You don't need to be a genius. You don't need to be a rocket scientist. You don't need to have a PhD in finance. Just the fact that metrics that was supporting economic growth and supporting Fed's rate cut decisions, investors applauded. Something that goes wrong, investors hated it, drove the sell-off. It's as simple as that. There's nothing more I need to say. What I will say, however, is that it is not just the economic data and the uncertainty that's driving the sell-off in the US markets. This is something that I want you to really consider, given that the cocktail that I mentioned earlier is what everyone likes to point to the reason for point to as the reason for the recent sell-off. While the cocktail of factors, tariff policies, government layoffs, immigration crackdown, all of that could very well be the primary driver that's leading to the sell-off, it is not the only driver. Investors who were heavily invested in US stocks are now diversifying their portfolios by investing in European and other international markets. This shift is attributed to concerns over US market valuations and geopolitical tensions, particularly with Europe. And ever since the European Union announced increased defense spending, there has been a particular liking for European defense names, and these are attracting investors. My former boss and a very close friend of mine would be absolutely thrilled to hear this, because he has invested. He's invested. He's long on defense names. He's been telling me that the European defense names would do good, and boy, are they doing very, very well. So basically, there has been a shift from the US markets to European markets because of this, because of the valuation differences. The price to earnings ratio for the S&P 500 is much higher than that for any of the major indices, making international markets more attractive for value investors. At the same time, 9 out of the 11 S&P 500 sectors are experiencing decelerated earnings growth, with tech valuations particularly under pressure. This trend began before tariffs were announced, before immigration crackdown, well before DOGE even came into existence, which suggests that tariff policies, immigration crackdown, the entire cocktail of factors are not the only thing that are driving the pessimism in the US markets. Now, what I want you to really focus on, the other thing that I want you to really focus on is there is an argument in recent days, because of the sell-off that is seen in the US markets. There is an argument in recent days that the era of American exceptionalism might be coming to an end. Natural question that you guys would have for me is, what on earth is American exceptionalism? No problem. Put simply, it's this entire phenomenon that I'm about to describe, that's American exceptionalism. Okay, the American economy is considered exceptional. Why? Due to its wealth, innovation, and high growth rate compared to other developed nations. What investors and economists are arguing today is that this exceptionalism may be fleeting. Uncertainty surrounding trade policies and the future strength of the US dollar has led some European investors to withdraw from American stocks. And it's just not European investors, it's investors across the board. Any foreign investors who have put their money in the US are now taking their money away from the US market. Now, this trend is observed for less than 100 days into a second Trump administration, prompting discussions about the potential end of American exceptionalism. Now, I don't particularly agree to this thesis. Okay, because what I see, in my opinion, what you are seeing in the market is a simple old-fashioned rotation. And mistaking a rotation, which is not uncommon, by the way, for the end of American exceptionalism is foolhardy, in my opinion. The US economy's exceptional nature is attributed to its deep and liquid capital markets, which efficiently allocate capital to productive sectors. Additionally, the US economy's dynamism supports dynamism. Sorry, my bad. Dynamism supports innovation and productivity, making it a hub for technological advancements and entrepreneurship. I just don't see the tariff policies or immigration crackdown as threats to any of these factors that contribute to American exceptionalism on a structural basis. And what I mean by that is on a long-term basis. Innovation and productivity continue to thrive, in my opinion, and a short-term correction or a short-term rotation or even a medium-term rotation in the markets, it simply doesn't mean that structurally American exceptionalism is dead. I'm going to take a step further and say that I think this perceived fear on account of uncertainty has taken the sell-off seen in the markets a bit too far, which has led to this false thought that American exceptionalism is under threat. What I repeat, what I see in the markets these days is just a good old-fashioned pullback, which has led to good old-fashioned rotation, rotating out of high-valued US names into low-valued European names and other international names. I know Tim Seymour, an individual who I really, an investment manager who I really admire on Fast Money, he calls it the MEGA, Make International Great Again, which is kind of what's happening, I think, what's right now. He's an expert on international markets, and he has a point there. So what you're seeing is a high-valued US market, the rotation out of the high-valued US names into the low-valued European Union name. So MEGA, as you call it. So sorry, Mr. Seymour, it's your trademark. I know. I'm giving you the credit for it, and I do think that what he's saying makes a lot of sense. Now, could there be a growth and slowdown? Sure. Could there be a recession due to Liberation Day impact? Possibly. Does that mean that does the slowdown in growth, potential recession due to Liberation Day impact, the labor market crumbling, all of that? Possibly all of these could happen, but does that mean that the likes of Amazon, Nvidia, Microsoft, and even Tesla are simply going to stop innovating? Does that mean that suddenly the US markets are going to have their liquidity sucked out to an extent that efficient capital allocation stops for good? I mean, if you think so, please go ahead. Cash out for the US markets for good, never return back, but do so at your own peril is all I'll say. President Trump and this administration might jolt the US economy. They might even reshape the global supply chains. April 2nd would provide clarity on all of these things. That April 2nd is tomorrow. You don't even have to wait for long. It's 24 hours. These things would provide clarity on these things. But I don't have to wait until April 2nd to say that proclaiming the death of American exceptionalism due to one administration's policies it's all I'm saying is that is as good as proclaiming that pigs could indeed fly. The US economy, long term, not going anywhere, in my opinion. US stocks, long term, not going anywhere, in my opinion. And long term investors will continue to gain throughout this period of volatility. April 2nd is simply not going to change that. On that note, on that very affirming note, let's head to the next segment. The doctor goes home. And before I even get to the doctor goes home, first of all, belated Eid Mubarak to everyone. I know India celebrated Eid yesterday, so belated Eid Mubarak to all my Indian listeners. And thanks to Eid, Monday was a holiday, which means FY25 officially came to an end last week rather than yesterday. I mean, yeah, technically calendar-wise it ended yesterday, but on a markets basis, last trading day of FY25 was on Friday. And what an eventful fiscal year it was. So much so I need a sip of water. This excitement is really getting, you need the sip of water. Now, what an eventful fiscal year. It was pretty much a tale of two halves, I would say. Or should I say it's BT and AT? Before Trump and after Trump. I don't know. I know Donald Trump is the president of the US, but boy, did his policies and statements have had a seismic impact on the Indian markets till date. I mean, he even called he called out India again on Friday for imposing high tariffs on the Americans, on the American goods and products and services. So boy, did he have his, is he continuing to have solid impact? And when I say solid, not necessarily positive at times, but it's a significant impact on the Indian market. So that's why should I call it BT-AT rather than first half, second half of the fiscal year. At the same time, valuations were getting stretched in the Indian markets as we entered the second half of FY25, which made selling stocks a lot easier, especially for foreign institutional investors. Once the dust had settled overall, it was a positive FY25 for the markets despite significant headwinds in the latter half. The BSE Sensex and the NSE Nifty ended FY25 with gains of 5.4% and 5.7% respectively. Despite experiencing 5 consecutive monthly declines from October 2024 to Feb 2024, a strong rebound in March helped improve their overall performance for the year. In fact, if it wasn't for March's performance, Nifty would have ended in the red for the year. So that's how bad those last 5 months were. Both indices reached their lifetime highs in September 2024, but thanks to the monthly declines from October to Feb, they ended about 10% lower by the end of the financial year. And if it weren't for, like I said, if it weren't for a strong March, boy oh boy, both indices would have been in the red for the whole year, despite having a very, very strong first half, reaching lifetime highs in September. So March just about helped them to finish in the positive territory. Foreign institutional investors, FIIs, found the second half of FY25 as the opportune moment to book profits and dump the Indian shares as valuations became stretched and the whole sell India, buy China trade came alive. Overall, FIIs were net sellers throughout FY25, which makes the positive end to both Nifty and Sensex a really, really miraculous affair. The FIIs offloaded Indian equities worth 135,162 crore rupees. They sold in 7 out of the 12 months, with the most significant sell-off seen in January. The only silver lining is that in the last few days of the financial year, they've started buying again, investing around 19,000 crores, driven by improved valuations and a much stronger rupee. There was an attempt by domestic institutional investors, the DIIs, to mitigate the relentless selling by FIIs as they were net buyers throughout the year, with purchases totaling 596,204 crores. Their highest buying came in October. Ironically, it was the same point when the market's 5-month declining streak began. So the net buying, the buying impact of DIIs just could not offset the overall selling by the foreign institutional investors. Now, if one looks at sectoral performance, defense stocks, it was a great year for defense stocks. The Nifty Defense Index surged 37%. Financial services, pharma, metal, and consumer durables also performed well, delivering double-digit returns. Media, energy, public sector banks, and oil and gas sectors did underperform, however, with declines ranging from 8% to 16%. After a strong start to the financial year, the Indian markets were hit with a host of weak economic data and uncertain headwinds, which led to the 6-month declining streak. For instance, the unexpected fall in the second quarter of FY25 GDP to 5.4%, which was a 7-quarter low, contributed to market volatility. Weak corporate earnings in the second and third quarters of FY25 further impacted market sentiment negatively. In addition to these twin shocks, you obviously had other factors like the US bond yields, strengthening US dollar, and global economic uncertainty, all contributing to the investors' decision to sell, sell, sell. And like I said, I told you this multiple times at the start of the segment. It is very clear that if it weren't for the strong March performance, FY25 would have been a negative year for the Indian markets. But the question that investors need to ask themselves is if March was a one-off positive month, or are there factors that would suggest that the bullishness has indeed returned to the Indian markets? Now, in the long term, I continue to be a perma bull on India. You guys already know this. I mean, you've been following me, especially for those who've been following me for 3.5 years. You know I'm a perma bull on India. But in the near term, I would be urging caution when it comes to buying in the Indian markets. I do have my wish list, and I am looking at adding to my names in the portfolio that have been heavily beaten down but are high quality. But I would still be urging caution when it comes to overall buying in the Indian markets. The obvious reason behind this cautious approach is we still don't know how much of an impact India would face from President Trump's Liberation Day on April 2nd. And even if there are tariffs, we still don't know how long they will last. I mean, the Indian auto companies already know that they're going to face some indirect heat, given that President Trump has already imposed 25% tariffs on all foreign auto imports. Although India's direct vehicle exports to the US are minimal, the tariffs will affect Indian companies through global supply chains. For instance, Tata Motors, a name I continue to invest in, I continue to get, a name that continues to cause me immense pain. Tata Motors subsidiary, Jaguar Land Rover JLR, sells 22% of its vehicles in the United States. And these UK manufactured cars will face higher import costs. Eicher Motors Royal Enfield 650cc motorcycle, popular in the US, may see reduced demand due to increased costs. Auto component companies like Sona BLW Precision Forgings, which derive 66% of its revenues from the US and European markets, face high exposure to tariff-driven cost hikes. In response, Sona BLW is expanding its operations in China, Japan, and South Korea to reduce dependency on Western markets. It was clearly evident in the stock prices of many of these companies immediately following President Trump's announcement. I mean, you had Tata Motors that fell over 5%, Eicher Motors dropped nearly 2%, Hyundai India slipped 1.7%, Samvardhana Motherson plummeted 6.4%, Sona BLW lost 4.4%, and Balkrishna Industries declined 3.4%. Going forward, given that President Trump has called these auto tariffs permanent, it is vital that Indian automakers and suppliers adapt through market diversification, localized production, and cost optimization to remain competitive in a changing trade landscape. The only issue is that it takes a long time. It's not like switch, nah. Light off, light on doesn't work with global supply chains. So it's going to take some time, and automakers in the near term are going to face some heat, in my opinion. The automakers that I mentioned, auto component makers as well that I mentioned. Now, keep in mind, that's why, keep in mind that this is one of the reasons why I'd say probably bring some caution. Just don't get, dragged down, or, you just don't get like your hopes boosted by a strong March saying that, okay, I'm just going to go gung-ho investing. Just take your time, be cautious while investing, in my opinion. Of course, do your own due diligence, not an investment advisor. So obviously, do what you got to do. But that's what I would do is caution. What about other sectors, right? I'm talked about automakers for now, the 25% tariff. We know what is going to happen there. It's a clear-cut fact. And right now, President Trump has called them permanent, so we know that there's going to be an issue. Now, what about other sectors? Now, there is an argument that reciprocal tariffs would be unnecessary given the fact that bilateral trade agreement is being discussed between India and the United States. The talks are part of efforts to expand trade between the two nations to $500 billion, $500 billion by 2030. Assistant U.S. Trade Representative Brendan Lynch led a delegation to India from 26 to 29 March to discuss the BTA, the bilateral trade agreement. The talks did not result in any immediate tariff exemptions, but laid the groundwork for future negotiations. Both nations aim to finalize the first part of BTA by autumn 2025, with any tariff-related announcements expected after September. In this scenario, a lot of our economists are arguing that we may not need, reciprocal tariffs are not needed because we are in the process of negotiating trade with the United States, bilateral trade agreements, so probably give us some relief. It's a good agreement, it's a good argument, but in my opinion, it's one that's unfortunately marred with irrational optimism. President Trump has repeatedly called out India every time he talks tariffs. He did that even as early as last Friday. At the same time, going by the current trade deficit, then the US currently faces a trade deficit of a whopping $45.6 billion with India. On average, the US tariff rate imposed on India is 2.2%. What did we impose on US goods? 12%. 2.2% US, 12%. So that's no joke. Yeah, that the difference is no joke. The US seeks duty concessions on products like automobiles, wines, petrochemicals, dairy items, agricultural goods such as apples and walnuts. There have been even attacks by officials of the Trump administration, not President Trump himself, but Commerce Secretary Howard Lutnick and so on, in the recent past, claiming that India keeps US farmers out of the market through tariffs. So when you put all this together, I don't see any reason why India won't be targeted as part of the reciprocal tariffs, Liberation Day, whatever you want to call it. Okay, it may not be as bad as initially feared, given the talks related to BTA are underway, but I don't see any chance that the country would be completely immune. As such, some short-term to medium-term pain is to be expected, and certain sectors such as pharmaceuticals and agricultural goods are likely to face the heat in the coming months. So there would be some weakness likely to be a weakness in the names in these sectors. So this is another reason why I say urge caution. I urge caution, be cautious is what I would say. Now, having said that, it would also depend on what other countries are charged. Remember, reciprocal Liberation Day is not just for India, it's for everybody in the world, according, at least if some reports are to be believed. If some reports are to be believed, it's for a select number of nations. Problem is, India is also part of that list, this rumored list. We'll find out in 24 hours, guys. We'll find out in 24 hours. But for instance, So it would depend on what other countries are charged in terms of reciprocal tariff. For instance, India's position in the US market is seen as advantageous compared to major competitors like Canada, Mexico, and China, which will face tariffs ranging from 20 to 25%. Now, this could create opportunities for Indian exports to gain market share. And there is a rationale for this argument. Historically, when the US imposed duties on China in 2018, countries like Taiwan, Vietnam, Thailand, Mexico, and India gained from the shift in trade dynamics. This precedent suggests that India could similarly benefit from current tariffs. Now, while this is a perfectly reasonable argument, the only issue I have with this is that Trump 2.0 is not the same as Trump 1.0. As such, it would not be the most optimal way to compare the two periods, which means that investors would need to take extra caution this time around while evaluating the extent to which India could benefit from the tariffs charged on other nations. Investors also need to factor in that India's service exports decreased to $31.6 billion in Feb 2025, marking a decline for second month in a row. This follows exports of 34.72 billion in January and 36.96 in December 2024. Moreover, India's core sector output grew only by 2.9% in Feb, marking a decline from the 5.1% growth recorded in Jan 2025. It's the lowest growth rate in 5 months. So there are some economic data which, while not raising alarm bells, do suggest that things are not as straightforward as they were at the start of FY25. Add to this potential headwinds from reciprocal tariffs, and caution is certainly warranted. FY25 overall, when you look at it, was mixed for investors, but it certainly ended with a bang. While there are reasons to believe that FY26 would be a much, much better year than FY25, I simply wouldn't go in all guns blazing. On that note, let me welcome you to the final segment. Dr. Dissects, not quite the Mag 7, certainly yet another potential AI beneficiary goes under the microscope this week. Salesforce, my number one idea for 2025. Ticker symbol CRM. Now, Salesforce announced its fourth quarter performance last month, and you've heard me speak about Salesforce for a while, and you should know that in what has become a trend in recent quarters, the fourth quarter performance was mixed. Yeah, while non-GAAP EPS of $2.78 comfortably beat analyst estimates of $2.61, revenues of $10 billion, which are up 9% year over year in constant currency, missed analyst estimates by $42.51 million. While the EPS also managed to trounce both the high end of the company's Q4 guidance, which was $2.62, the prior analyst consensus of $2.65, Q4 revenue growth once again failed to cross double digits. Having said that, revenue growth is back on the rise again, as the growth was 8.3% year over year in Q3. Current remaining performance obligations, CRPOs, registered yet another quarter of double-digit year-over-year growth, jumping 11% year-over-year and coming in at $30.2 billion. Non-GAAP operating margins slipped marginally on a sequential basis, coming in at 33.1% in Q3, 33% in Q4. Free cash flows once again came in very strong, jumping 31% year-over-year to $12.4 billion. Guidance, similar to the previous quarter, was disappointing in my opinion. For FY26, the company expects revenues to come in between $40.5 and $40.9 billion, with the midpoint of $40.7, missing consensus estimates of $41.5 billion. For the full year, non-GAAP diluted EPS is expected to come in between $11.09 and $11.17, the midpoint of which would assume a year-over-year growth of 9.1%, significantly lower than the 24% year-over-year growth seen in FY24. Finally, free cash flows are expected to come in at $12.4 billion, which translates to an impressive year-over-year growth of 31%, probably the only positive you can take from the overall guidance. Now, I continue to be bullish on Salesforce, despite the stock being absolutely battered in recent days and despite all this guidance being mixed and all that. Now, let me explain to you why I'm bullish, because this This segment is not about me simply telling you the earnings. It's also about dissecting the earnings report and taking and analyzing the main takeaways. So on to the takeaways we go. Last time I spoke about Salesforce. I had made a case for the company's flagship AI tool, Agentforce, to be its next major growth catalyst, one that could potentially cement the company's leadership in the enterprise software sector. The data from the company's Q4 report has confirmed this thesis. In the third quarter, the company had signed 200 Agentforce deals within a week of its launch. By the time the fourth quarter ended, and that's 3 months, remember, ladies and gentlemen, that number had jumped from 200 to 5,000, 3,000 of which were paid Agentforce deals. Exponential growth is what we are seeing here, and it just confirms that the tool, as I predicted, is gaining so much traction among enterprise software customers. Furthermore, the company's top 10 deals for the quarter included AI and data cloud, which further shows the pull that Agentforce has had. It was also pleasing to see that the company has already as a ready-made demonstration of Agentforce on its own website, which shows the confidence that the management has in this particular tool. Now, while it's still early days, the pricing model for Agentforce also seems to be attractive to customers. During the earnings call, CEO Mark Benioff hinted that Agentforce accounts for about 35% of a company's annual contract value, ACV. Mr. Benioff highlighted that it was the case of one such customer, but assuming that this is the ballpark figure in how Agentforce is priced, then it certainly is a good start, in my opinion. What is also positive to see as a Salesforce shareholder, and I've invested in Salesforce, was the halo effect that Agentforce was having on the company's other products. Management confirmed that the presence of Agentforce is making each of the company's core applications better, which bodes well for the company's entire suite of products going forward. Now, the company does not expect Agentforce to make any meaningful contribution to its revenues until FY27, which explains why FY26 revenue guidance was relatively weak. Having said that, in a world where every company is touting its agent as the next big thing through anecdotal examples, and at a time when the entire AI revolution has been upended by the DeepSeek saga, Salesforce has managed to hold its ground through Agentforce. And investors, in my opinion, can see that the tool is set to be the company's next growth catalyst, one that ensures the company is on track to be the king of enterprise world, not through anecdotes, but through hard, concrete evidence. Now, the other takeaway is that one of the frustrating things about investing in AI-related companies, and I've invested in a few of them, all publicly listed, of course, is that they talk a lot about their investments, and they provide a lot of insights into why these investments are necessary. One would be hard-pressed to find companies in the sector who clearly outline how they are monetizing their AI investments. Luckily, Salesforce is one such exception. Given the success it has seen with Agentforce, the company for the first time had a new metric, which was the annual recurring revenue from Data Cloud and AI division. It showed that the annual recurring revenue of this particular segment, the Data Cloud and AI segment, reached $900 million, which translates to a year-over-year growth of 120%. Now, this is the kind of data that investors want to see whether the investments are translating into returns or not. In my opinion, it also demonstrates the company is confident that this metric would be strong in the coming quarters, which cannot be surprising given the exponential growth seen in the rate of adoption of Agentforce. Admittedly, I've got to admit the 900 million figure is a drop in the bucket for a company that just generated $37.9 billion in revenue in the whole of FY25. It's not an issue for me, though, since management already acknowledged that it would take time for the AI tool to meaningfully contribute to the overall revenues, like I mentioned earlier, not until FY27. Moreover, the halo effect of Agentforce implies that it is already an indirect contributor to the overall revenue growth, and it could very well be an indirect it could continue to be an indirect contributor to the overall revenue growth in the coming quarters. What investors should actually be pleased with is that the company clearly separates its AI-driven revenue from the rest. And it's something that the company's peers should be attempting to replicate, in my opinion. That's the other takeaway, the fact that they have a data cloud and AI metric. Now I'm going through the pages, getting a blank page of the notebook, because that can only mean one thing. We are about to discuss valuations. So we are discussing Salesforce. CRM, right. According to LSEG data, Salesforce currently trades at a forward price to earnings of 27.2, in line with Microsoft 27.9, but significantly cheaper than the likes of Snowflake, which is a whopping 156.2, and ServiceNow, which is 55.4. Now, relative to its historical multiple, the company currently trades near its 2-year median historical forward price to earnings of 26.7. The last time I talked about Salesforce, I assumed a historical forward price to earnings of 34.7, which was its 5-year forward price to earning multiple at the time. Since that last article and since the sell-off, this particular multiple has come down to 32.1. Despite the growth potential seen in Agentforce, the AI tool is not expected to make meaningfully, it's not expected to meaningfully contribute to the company's top and bottom line, at least until FY27. Furthermore, my FY26 EPS estimate last time was $12.12, based on a year-over-year growth of 15.8%. However, even if I assume the high end of the management's guidance, which was $11.17, earnings growth would be 9.5%, lower than my previous projected figure of 16%. Having said that, if one looks at Salesforce's history, and one can see that the company has been very conservative with respect to its guidance. It has beaten the high end of its own EPS guidance in every year for the last 5 years. The magnitude of the beats also has been significant, with the exception of FY24. On average, based on LSEG data, the company has beaten its own high end of the guidance by 3.26%. And in my opinion, there is no reason for the company not to repeat this feat in FY26 as well. I have assumed that the company would beat the high end of the FY26 guidance by 3.26%. So you have projected FY26 EPS now comes at $11.53, and EPS growth would be 13%, still lower than the 24% it achieved in FY25, but closer to its long-term average growth of 15.7%. So projected EPS FY26 is $11.53, which would translate to a growth of year-over-year growth of 13%, closer to its long-term average of 15.7. Now, given my projected EPS growth is closer to the company's long-term average growth, I have assumed the company's 5-year forward price to earnings multiple, and that 5-year forward price to earnings multiple is 32.1x. So that's what so basically it's closer to earnings growth. So I've taken the earnings growth of 32.1x. A forward price to earnings of 32.1, multiply that with 11.53, and you get a price target of 370. Now, this price target is far lower, much lower than my previous target of 421, but it still implies an upside of about 37% from current levels. So despite lowering my price target, I still maintain my buy rating on the stock, given the significant upside as well as the catalyst that I've talked about. So price target, here we go, guys. Price target 370, 37% upside, and I'm maintaining my buy target, even though it's lower than my previous price target of 421. And I got to tell you, I boost up my Salesforce position post its earnings release, and I'm actually looking to add to it, given the fact that it's fallen a further 10% since then. So based on the overall market weakness, so I'm looking to add to my position. A bit of a disclaimer there. Now, it's still a bull case, so I have to discuss the risk factors. And the main risk factors to my bull case is if Agentforce, despite its potential, fails to reverse the slowing revenue and EPS growth. As I talked about earlier, management expects Agentforce to meaningfully contribute to revenue growth only by FY27. Should even this fail to materialize, and if the company sees yet another year of single-digit revenue growth and a further decline in EPS growth, then it would have a negative impact on my bull case and on the stock price. The other risk factor that investors have to factor in is that Salesforce management is seeing yet another major shakeup, with both Brian Millham, who was COO, and Amy Weaver, who was the CFO, departing the firm. Moreover, COO and CFO roles are being merged into one. It's now called COFO, which would be taken up by Robin Washington. Now, a management shakeup always brings uncertainty, in my opinion, but merging the COO and CFO roles bring with it an additional layer of complexity, something that I would consider as a risk factor for investors to consider. Bottom line, it was yet another mixed quarter from Salesforce, with revenues missing analyst estimates once again, revenue growth failing to hit double digits once again. Despite this, to me, there were a lot of positives, with the exponential growth seen in Agent Force being the main one. I was not anticipating the number of deals to go from 200 to 5,000 in one quarter, which simply demonstrates the ability of this tool to become a significant growth catalyst. Moreover, I also like the fact that the company has introduced a data and AI ARR metric, which clearly shows how the company has been monetizing its AI investments. While the figure is a drop in the bucket compared to the overall revenue, the clarity that Salesforce provides investors through this metric is much needed and is something that its peers should replicate, in my opinion. The ARR figure nonetheless also shows that the company is making positive progress in the AI world. Post the earnings release, the company's stock tanked more than 4%. It's been on a free fall ever since, which to me only makes it more attractive. Salesforce was my top long idea of 2025. The mixed Q4 report is not going to change that, thanks to the progress seen in the adoption of Agentforce. That's all the time I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttamvinay, UTHMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. I will see you next week. Until then, stay safe and make some money.